Let's get to our market recap. So, as I mentioned, today as we look at what's evolved, thinking about our wrapping of the week here, it's been a lot of movement here. I want to just update very quickly on what happened today. I want to share with you a poll, and then we're going to get to a deeper analysis of the weekly trends today. So, the S&P actually finished down almost 2/3 of a percent, sitting around 3215. Mid caps down a little bit more, but small caps really led the way lower. So this rotation back into small caps that we've been seeing sort of took a breather today with more of a risk-on move, really continuing the risk-on trend that we saw yesterday. The NASDAQ 100 led the way lower with the major indexes, with the technology sector, the XLK down 1.2%. Very quickly on the other markets, the TLT was flat. So bonds were flat for the day. The dollar continued to weaken, going down another 0.4%. So that weaker dollar theme, strength in emerging markets, that's all been a part of it. The commodity side, gold really was the leader there, natural gas and others as well. But in terms of the major commodities we've talked about, gold really led the way further. I want to share with you a poll, and the reason why I'm bringing it up now before we get to sort of our main segment is because this is something to think about as you start the week. And my question to all of you, what's your favorite time for a weekly chart review? Friday after the close, Saturday, Sunday morning, sort of coffee time, Saturday, Sunday evening, more of a happy hour with charts, or first thing Monday morning or some other time during the week. The overwhelming majority voted for Saturday, Sunday morning coffee time, which is awesome. That's actually when I enjoy doing it as well. What often I found, though, is to be honest with you, I end up prioritizing personal things, family things, and around Sunday evening, I think, I really want to spend some time digging into the chart. So I actually end up doing it more of a happy hour of sorts with coffee. So it's sort of a mashup of those two answers, I guess. But the reason why I ask that is not necessarily to tell you there's a right answer. There's a right answer for you, and not a perfect answer, but something that you will find fits most into your process. And I think that was the reason why I asked that question. Think about your time over the weekend when the markets are closed. Think about where you can prioritize a review of the markets when there's no stress, there's no pressure to be taking action. It's more of a time of reflection, just like you hopefully do in your personal life, mentally and spiritually and other things. Spending some time looking at the markets in a non-stressful time can be really, really valuable. I would think about when's a good time to schedule around that, and think about what the most importantly I would say is get into a consistent time when you can do it every week, because that's where I found people really elevate their process, elevate their decision makings if they have a routine time to go through the charts of interest to them. Thanks for answering that poll. I have a new poll running here shortly on StockCharts TV. Let's get to our Wrap the Week segments. This is where we're going to spend time using the Mindful Investor Live chart list. And the goal here is to look at how the longer term trends have evolved over the last week. We're going to start with a weekly chart of the S&P 500. I call this my market trend model. And basically, this is looking at long-term weekly data with the moving averages, 21 and 34-week exponential moving averages. The long-term trend for me is defined by the difference between the 21 and 34-week moving averages. This turned positive in early June, has remained positive through this week. So continues to tell you the longer-term trend is positive. For me, the medium-term trend, I use the weekly PPO, very similar to the weekly MACD, and just use a simple crossover system. That turned positive here in mid-May and has remained positive through this uptrend. Even with the pullback that we had out of the June highs, it's remained sort of long and strong in the uptrend. The short-term tactical read for me, again, I usually use the daily chart for sort of the tactical trend, but I like just having everything on one chart just for simplicity. So week to week, what's been the change between those two moving averages? And it's actually gone down today. Those moving averages have tightened up a little bit. So basically at this point, it's long-term bullish, medium-term bullish, short-term bearish based on the pullback that we saw today. Let's look at a daily chart. This is where I really would rather focus when I'm thinking strategically. And what jumps off the page for me is what's jumped off the page looking at a chart of the mega cap tech names, the mega cap communications names, consumer discretionary, all those sort of key leadership sectors that have had this bearish divergence, higher highs in price with the June peak and the peak we've seen recently, and then lower peaks in the RSI. So higher price, lower momentum is called a bearish divergence, and that suggests a weakening of sort of internal momentum. It tells you that there's less upside pressure on that second move than the first move. And again, the challenge with that is that's what most major tops tend to look like. If you look back here in January and February, you'll see a similar pattern. of lower peaks in the RSI, higher peaks in the price. Now, this pattern had emerged on major technology stocks, had not really come out on the S&P yet. I think given the sell-off we've had over the last couple of days, you can sort of acknowledge that we've had higher highs in price now with a new swing high that we've established, and now lower peaks in the RSI. So what that tells me is it's really suggesting limited upside. It's suggesting, you know, more potential for downside than upside overall. And I think we've seen those warning signs with technology, the strength in technology starting to dry up. You know, thinking of the limited upside with potential with a clear resistance level at the February highs. You know, what's the potential that the entire market could break above 3,400? I think the chances of that are actually relatively muted. When we broke out above that June high, though, my suggestion was I wouldn't be surprised if we hit 3,400, but I certainly feel like there's going to be some downside in here. So we actually could satisfy everybody. I think in the short term, what happens is the divergence puts it on my radar. It's not a raging sell signal. It tells you that a downside potential is imminent. For me, I'd want to see some validation from the trend. So the first things that would happen would be you start breaking down through trend lines. So if you connect a trend line using the late June low and the mid-July low, which actually just broke below that maybe yesterday to today. So that might be the very first thing. Second thing would be lower highs and lower lows. We've not had that yet. So until you start to reverse this pattern that we started in late June, it's telling you that the uptrend is still positive. So trend line break, check. Lower low, lower high, not there yet. Breaking down through key support in the form of moving averages also has not happened. So I'd be looking at the 50-day moving average. These lows from July, that's sort of that 3,100, 3,110 level. That's sort of the potential downside for me at this point based on the divergence. And if and when we break that, I think you have to reevaluate what's happening. What's interesting, though, is a breakdown like that will usually be reflected in individual stocks before it'll be reflected on the broad market averages. Let's go as quickly as we can through some of these other charts so we can wrap the week effectively. Next one is looking at breadth in the form of the cumulative advanced decline lines using my very subjective color coding system. I think it's positive for the S&P 500. For the broader NYSE, for the broader mid-cap index, I still see that as neutral, and I see it as neutral for the small-cap index as well. The mid-cap index is actually very close to breaking above the indication from the June high, which was also the same level that we had in February and the same level we had in January. So if we would break to new swing highs there, that would confirm what we saw in the S&P. It's not quite there yet, and I think it'll pull back a little bit today. This isn't updated through today's close just yet, but given how mid-caps pulled back a little bit, I would expect that to come off and not quite validate an upside level yet. So I think you have the S&P positive and all others neutral at this point. In terms of new highs, we've seen an expansion in new highs. And as we've talked about previously, a sustained uptrend is met by more and more stocks making new highs, because while the S&P is nowhere near really its high from February, that 3,400 level, a lot of stocks, as we know, in healthcare and tech and consumer have already broken above their February highs. And this is illustrating the number of stocks in the S&P, over 10% yesterday, broke to a new 52-week high. That's not a zero number. That's not bad. But you'd want to see a continued expansion of that and get back to the levels that we have seen in sustained uptrends, which we're not there yet. This is an interesting take. I think when you look at the percent of stocks above the 200-day moving average, we have over 50%, which makes me comfortable in the fact that the market overall is in decent shape. If and when we get back below 50%, that's when I start to think more like a bear and less like a bull. So again, that's another level I would be looking for. And again, not that that's a signal, but it's a signal for me. It's an indication to revisit some of the charts and see which ones are breaking down, because that means stocks are breaking below their 200-day moving average, which tells you some of the trends are reversing. We talked about the AAII survey yesterday, so I won't dwell on it, but just to note, I think if you look at the percent of bulls, it's nowhere near where we've been at previous highs for the most part, right? Highs usually have been 40+% bulls, and if you look back in some of the major tops going back, that's where it's been. We're nowhere near that, which, you know, tells me there's not this, even though it feels euphoric, and with certain anecdotal evidence like Robinhood accounts, it certainly feels like, you know, the Wild West of the late 90s euphoria, but I think on certain measures, it's not quite there yet. I think breadth is one way, and I think looking at the AAI survey as well. We are going to look at the name exposure index a little later in the show, which does actually give some signs of euphoria. You know, looking at the ratio of consumer discretionary to staples, it's interesting to see that this ratio has leveled out in the last couple of weeks, which suggests on a cap-weighted basis, discretionary staples pretty much even. It's actually been relatively neutral now for the equal weighted version as well, as Amazon sort of right-sized a little bit as staples like Kraft Heinz have emerged. Overall, they're sort of netting each other out. This is the really interesting takeaway on this chart, though. This is the ratio of consumer discretionary versus technology. This has clearly been favoring tech for a while now, and it's just almost barely breaking to a new 5-month high or so, 4 or 5 month high, which would be a very much a change of character, rotating away from technology as leadership, rotating into consumer discretionary as more of the leadership space. Interesting to see the two consumer sectors at the top of the list of S&P sectors just on today's trading alone. The relative strength of semiconductors, the long-term trend remains very positive. This week, the ratios turned down a little bit, put in a bit of a lower high here. So I think seeing a breakdown in this ratio next week would continue to confirm that rotation away from tech into other places. Now, traditionally, that would make me very nervous about the overall health of the market, because semiconductors tend to be a good bellwether group to illustrate overall market health. So that would be one data point to pay attention to. At this point, I think more than anything, it would illustrate this rotation away from tech, where I think a lot of investors have been parking for a while. This I tweeted out earlier, sort of ate it a bit on this one. I remember talking about this potential bear flag, the downtrend in the relative performance of small cap versus large, the upturn in that, and then we broke down through support. This is the first week in July, sort of signaled a rotation away from small caps back into large caps. From then, it's actually rotated back higher, so it's more in the neutral phase here. So interesting to see. It's actually coming up a little bit. If this is able to, break a new swing high, get above where it was at the end of June, that would, make me a little more confident about nibbling in small caps a little bit. At this point, it still tells me to be wary and think that it's more of the larger names that are driving things. Growth versus value has taken a bit of a hit. That's the regular growth versus value indexes. The next one we'll look at are the pure growth versus pure value, RPG and RPV. They both pulled back a bit, but haven't really broken down yet. A breakdown in that ratio would be similar to what we saw back here in early June, which suggested, a real change. This has been favoring growth over value for a long, long time. That would be an interesting rotation of sorts. The U.S. overall has stabilized a bit versus the world in the month of July, but it's really coming off highs that established in April, May. So overall, that long-term trend is still favoring non-U.S. versus U.S. stocks. I think that's an important theme to pay attention to as the dollar has weakened. EM continues to impress, rotating higher versus EFA. And then the very last chart I want to show you is stocks versus bonds. I put the amber neutral arrow, which I haven't used in about a year because it really isn't favoring either of the two. Stocks have been rallying, bonds have been rallying, and overall, the trends in general remaining positive in both places. So I think it's pretty much even between the two. We're going to take a quick commercial break, back answering your questions from the Final Bar mailbag. We'll see you in a minute.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.